Hi, my name is Jordan Wilson. In our last episode, we looked at some of the perceived disadvantages of using a buy and hold investment strategy. And when I said perceived, I meant things that you'll hear in the negative about buy and hold, but that are maybe a little bit weak, lame as far as criticisms. Today we're going to move into what I think are the more legitimate concerns when using a buy and hold strategy. And many of these criticisms we will have dealt with previously in other areas. So it's a nice continuation on that investing knowledge learning curve that we're going through. I think there's three valid criticisms of buy and hold. The first is that buy and hold may not provide maximum portfolio returns. Now, when we look back at the lump sum versus dollar cost average debate, we saw that in the long run, assets appreciate. So the sooner that you purchase and the longer that you hold, the more total growth. But that was over a long run period. In the short, medium term, we also saw that there was substantial price volatility. The logic then becomes, as a professional asset manager, or even as a investor who is listening to this, I can take advantage of that volatility through market timing techniques. I jump out when the market is high, I buy back in when the market's low. And that capitalizing and crystallizing the gains in the up markets and buying at substantial discounts in the down markets is going to provide much better returns over time than a buy and hold where you just buy and sit through that volatility. That is 100% correct. But let's go back to our lessons, our episodes on the ability of active asset managers, the professionals, to generate alpha through asset selection and market timing techniques. We saw that on a long-term consistent basis, it is very difficult to impossible for professional money managers to demonstrate that they can bring in alpha, that they can outperform the passive benchmark. And that passive benchmark is a buy and hold strategy. No one's sitting there with the S&P 500 or the TSX 300 and saying, okay, the markets are up, we better change our index construction. Or the markets are down, we'd better juggle things. No, the index is the index is the index. And that's buy and hold. So if your active professional money managers are not able to bring in that outperformance, that alpha, can you? So yes, in theory, if I can time markets much better than a buy and hold, but the data, the reality says that market timing is not simple. So if you can time markets, buy and hold is not going to provide you with the most optimal returns. But then the devil is in the detail. Can you time markets? Probably not. The second point I want to make is that buy and hold strategies do not provide bear market protection. So I'm buying and holding the S&P 500 or the FTSE 100 in the UK. Markets are falling. We're down 3%, we're down 5%, we're down 10%, we're down 20%. I'm just sticking with my index fund. Now, the smart investor will be identifying that we're in the midst of a recession, a depression, hyperinflation, something like that, that's going to have an impact one way or the other on a market. And when they see a down market, they're going to reallocate their portfolio into defensive stocks, in this case, maybe utilities. They're not going to be in the high flyers. And again, as the buy and hold person, you're stuck with what's ever in the index that you've purchased. And again, this goes back to our active versus passive investing debate. If you are good at market timing, if you are good at security selection, then active management is better than a buy and hold. But as I just said a couple of minutes ago, the data says that security selection is difficult. So we're in a situation here where, again, like the returns, active is the better way to go. But people that are professional money managers aren't able to take advantage of these situations and exploit them for profit. So should you be trying? And again, it's kind of like intuitively difficult to understand or accept, I guess is a better word, that the professional money managers can't identify the trends in the market. We're entering a bear market, let's shift here. And it's not so much that they can't identify the trends, it's just the getting in and getting out points that tends to cause the biggest problems. We saw that in an earlier episode where, again, if you are market timing, and we'd used an example of January 2000 until December 2018. And out of almost 14,000 days, if you only missed 5 or 10 or 30 of the best days that you got it wrong, in the case of the 30 days, your portfolio suffered by 81% versus the buy and hold. So it's just more a question with these guys and gals of not jumping in at the exactly right time or jumping out a little too late. If we look at, let's say, the 9/11 terrorist attack, the markets crashed. People start bailing because there's uncertainty. They don't know if there's going to be subsequent issues. But you would have been better off just maintaining the course, because by the time you jump back in, you would have missed out on a substantial gain, because people just don't operate that quickly. If we look at things like interest rates, for probably the last 6 to 8 years, there's been a continuous beating of the drum that interest rates will rise. And that drum roll is still going on. But interest rates didn't rise. And what happens is if you expect interest rates to rise, you lower the duration and, let's say, the maturity dates of your fixed income. The longer the exposure, the more interest rate sensitivity. So if you expect interest rates to rise, you want to lower your maturity and your durations. If you expect interest rates to fall, you want to lengthen. So a lot of people over the last decade, expecting interest rates to rise, shorten the durations of their bonds. Interest rates didn't rise, and the investors that stayed on the long end of the curve did much better. But this time I've been assured that interest rates will rise in the next 12 to 18 months. And given the printing presses operating in many countries in trying to purchase its way out of the COVID crisis that we're getting to hopefully the latter stages of as I tape this, there probably is a good chance that we'll see inflation, which will in turn drive interest rates up. But again, people have been saying that for the last decade, and it didn't happen. Another example that I like to use was the 2016 US presidential election, because that night I was inundated with text messages and emails from clients when they're listening to Nobel economist winning people like Paul Krugman say, it really does now look like President Donald J. Trump and the markets are plunging. When might we expect them to recover? A first pass answer is never. So we are very probably looking at a global recession with no end in sight. That was Paul Krugman of the New York Times, Nobel economist winning Paul Krugman, the day after the 2016 election. Go back in Yahoo Finance or Bloomberg and track the progression of the Dow 30, the S&P 500, NASDAQ 100, etc. from early October 2016 until just before the COVID, because that would be a completely different event. If you'd listened to Paul Krugman, you'd bailed out of the markets. Not a smart strategy. Eric Zitsowitz, former chief economist at the IMF in November 2016. Another smart guy. If Trump wins, we should expect a big markdown in expected future earnings for a wide range of stocks, and a likely crash in the broader market if Trump becomes president. I can see why Mr. Zitsowitz is former chief economist at the IMF. Or for those of you that study economics and the IMF, it makes you understand the IMF a little better. Simon Johnson, economics professor at MIT in November 2016. Trump would likely cause the stock market to crash and plunge the world into recession. MIT. A good prof to take, I'm sure. Citigroup. A Trump victory in November could cause a global recession. So, the pros get it wrong. And from a personal perspective, I think a lot of times there is a mixing of professional, unbiased, objective analyticals with personal biases. So we don't like Trump. Orange man bad. So we can't come out and say, if I want to keep my job at the New York Times, that he's going to be good for the economy. So everything we look at tends to be tainted or flavored with these personal biases. And that's fine. But again, people like yourselves that are listening to these experts who are espousing their views and relying on their Nobel Prizes in economics, you have to realize that they're taking more political stances. And it happens on the other side. I'm just using this as a good example because it resonated so well back in 2016. And yes, I did tell my clients to stay the course because I didn't see anything catastrophic with the election, regardless of which way it went. I think the other aspect too, from a behavioral finance side, is that there's the herd mentality. All these people are part of the same gang, the same clique, and they want to be liked by each other. So they like to say things that other people, their peers, their friends agree with. And that's less herd mentality. The herd mentality side is more, okay, if Krugman, if Zitsowitz from the IMF, if the MIT economics professor are all saying, Orange man bad, the world is going to fall under a Trump election, then I don't want to be that outlier. Because if they're right and I'm wrong, I look like an idiot. So I would rather be wrong and hide in amongst the herd and not be picked off by the cheetah or the lion on the edges than take that outlying position. And maybe I'm right and I look good, but if I'm wrong, there's no punishment because I'm part. My boss calls me and says, Jordan, you sure screwed up that presidential election analysis. I said, well, yeah, maybe, but Paul Krugman, he came to the same conclusions and he's a smart guy. MIT, IMF. We just looked at the data and we all came to the same conclusion. We just happened to all get it wrong. That's not our fault. It's the data's fault. So I think that's an issue. And then if we go to sort of in the same vein, I think that down market protection does get at one of the less legitimate concerns we discussed last time, and that was the stress. If I'm losing money, unrealized gains or portfolio losses because I'm standing pat in a down market, that is stressful. If I'm taking that contrarian approach while everyone else is shifting into cash in a bear market or depression, and I'm holding the course, being alone on an island is also stressful. So sometimes, again, shifting allocations may not be the best approach, but it is a little bit easier if you're part of that herd mentality from an investor side. The final point that I want to make that is a valid criticism is that under a buy and hold, you need to be immortal. And I can hear Freddie Mercury from Queen singing in the background on this. Who wants to live forever? We just said that in the long run, appreciating assets do appreciate. But that's the long run. Again, we looked at the Dow in a prior episode. Over 100 years, you see the trend going straight up. But within that 100 years, there's periods, 25 plus years, where you may be having to hold your assets before you recover. We saw that after the great market crash, sort of in that 1930s time frame. Huge amount of time to recover. We saw that as well in the 60s. Now, if you're 20 years old, 25 years old, and your only financial objective is retirement at 65, you can withstand the short and medium term volatility, and you will come out okay. But investors have short-term goals. I want to buy a house in 3 years. Medium-term goals. I want to finance my child's education in 15 years. So that's an issue. You don't want to be caught in that volatility for your short and medium-term objectives. Also, we are not immortal. The 25-year-old that's investing with a financial objective of accessing the cash in retirement at 70 has a substantial time horizon, over 40 years. That same person is suddenly 35. Instead of a 45-year time horizon, it's now 35. And then they're 45, and it's down to 25 years. So the older you get, your longer term objectives become medium and then short term in nature. And if you get caught in a crash that doesn't recover in the next 5 or 10 years, you may be on the wrong end of the stick with a buy and hold strategy. So those are 3, I think, legitimate concerns. And I think that they need to be addressed if you are going to invest in a buy and hold strategy. Now, we did see that for 2 of them, active asset management will provide you with higher returns and give you down market protection. And as we've discussed in many prior episodes, active management tends not to work. So buy and hold is probably a suitable alternative. And dealing with the immortality is another issue that needs to be looked at. And when we get into a couple more of our sessions covering buy and hold and reviews and rebalancing and these sort of things, we'll see that buy and hold, yes, but we need to put in some tweaks. And one of those tweaks would be that you periodically review and rebalance your portfolio. So if my portfolio is a simple 70% equities, 30% bonds, and the equity markets have just taken off, huge bull market, and now we're up 30%, and I suddenly find myself 85% in equities, 15% in bonds, and my personal circumstances are the same. I want to rebalance back to my target asset allocation. So I'm going to take some of those profits from the equities and put them into the underperforming fixed income. So again, that helps deal with overinflated or underinflated markets. And on the downside, we talked about that with dollar cost averaging. You buy more units when the prices are low, and you buy relatively less units when the prices are high. So that helps deal with investment markets that get out too far in advance or too far below. You're kind of smoothing things out. So that's sort of what we'll look at down the road in how does buy and hold work best? How can we tweak it? That's all I want to cover for today. Thank you very much for your time. Have yourself a great day.